Hey everyone, George here. So if you're new to the channel, we talk all things accounting for contractors here. And with the new bill that got passed, if you either purchased or plan on purchasing a personal vehicle in 2025, there's a new tax perk that you should be aware of. So that's what we're going to talk about today. So let's get started. So with the new tax bill that got passed here in the summer of 2025, the OBBBA, there's a new rule that lets you deduct up to $10,000 of interest on a personal vehicle that's purchased in 2025 or later. And the nice thing about this is they let you take this deduction whether you itemize or take the standard deduction on your personal return. So if you finance a $40,000, $50,000 or $100,000 personal vehicle, this one's going to be right up your alley. So simply put, on a personal vehicle, you can deduct up to $10,000 of interest on your personal tax return. So now what all is required to qualify for this deduction? Number one, the vehicle needs to be brand new. It can't be certified pre-owned, it can't be used, it needs to be brand new, fresh off the lot. Number two, it has to be financed on or after January 1 of 2025. Unfortunately, there's no retroactive deals, things you purchased and financed prior to 2025, they wouldn't qualify. Number three, it must be assembled in the US. Obviously, this would knock out a lot of popular imports. You can check with your VIN number and I'll put the link down in the show notes. Number four, it must be under 14,000 pounds. So no heavy duty commercial rigs, but pretty much all F-150s, Silverados, Rangers, Tacomas, SUVs would pretty much qualify. And number five, it must be used personally and not as a business asset. So this one trips up a lot of people because if you use it as a business asset in 2025 and going forward, you already have the advent of bonus depreciation and Section 179. So I mean, this wouldn't even be needed by you. This is actually for personal vehicles. It could be your spouse's vehicle, it could be your own, but not for use for business. So this is going to be the one that you don't use for work. Now, what are the income limits? There are some phase outs involved, and let's go over that real quick. So if you're a single filer, your phase out begins at $100,000 of modified adjusted gross income, and you're completely phased out by $150K. And if you file jointly, your phase out begins at $200,000 and it's completely phased out by $250,000. So if you're below these amounts, you can take the full deduction. If you're in the range, you get some limited amount. And if you're above, you get, unfortunately, no deduction at all. And one other thing is that it expires after 2028. So you have 2025, 2026, 27, and 28 tax years to, utilize this interest deduction. So who would this not be suitable for? Number one, contractors who want to write off a truck for a business. Because at the business, you're already getting bonus on 179 and deducting the interest expense for the business use portion anyway. So, I mean, this thing is kind of pointless to you. Like, you're already getting the full perks of the business. This is specifically for personal vehicles. Number two, high earners over the income limits that I mentioned. 150K if you're single, 250K for married filing joint. Number three, anyone planning to buy a used vehicle. And number four, anybody buying a vehicle that's not made in the US. So again, that's pretty quick on for today. You can deduct up to $10,000 of interest expense on your personal return, whether you itemize or not, for a personal vehicle financed in 2025 going all the way through 2028. For a US made vehicle, must be personally used, must be under 14,000 pounds, and you have to be within the income limit. So there you have it. Pretty quick one, pretty easy, but a nice one to throw on the tax return and get another couple $1,000s tax savings. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.